Welcome back. So welcome to the 2021 NIC Fall Conference. It's been about 18 months since the industry got together again last time at our spring 2020 conference in San Diego. During that time, it's many of you and many of your organizations have been on the front line, literally protecting the most vulnerable among us. And so I wanted to start off certainly by thanking you, your organizations, for everything you've done, everything you continue to do to provide millions of Americans with a safe and happy place for them to call home. So thank you very much. I also want to thank everyone here that's registered and attended. I want to thank our premier sponsors, our official sponsors, our event sponsors. So we're a 501c3 not-for-profit. Our mission is to enable access and choice for older Americans. But it is really it's through conference registrations, it's through the partnerships, and it's through event sponsorships that we have essentially revenue to support what we do. And so without your support, we literally wouldn't be able to do what we do. And so thank you very much for all of your support. I would also like to thank our volunteer leaders, specifically the volunteer leaders on our Fall Conference Programming Committee. And so it is a group of industry leaders that have put together what they believe to be the most important topics for your industry, or I should say for your businesses at this time of change. And so certainly you should take advantage of all 10 sessions we have over the course of the next couple days. And then, of course, I want to thank our board, an incredible group of volunteer leaders who, over the course of the last 18 months and even longer, have really helped provide the strategic guidance for us as we went through this unusual time. I'd like to specifically call out Mr. Kurt Reed, our board chair. So his 2-year term as the volunteer chair of the board was supposed to end at the end of 2020. And he graciously agreed to continue in a volunteer capacity to help us through this let's call it extraordinary time, and incredibly appreciative of all the time, energy, and effort he's put in. And so Kurt will have a couple of words tomorrow morning, right before the 10:30 session on kind of the policy outlook. And so I'd certainly encourage you to make sure you're attending that as well. So I know you're not here to hear me talk, and without further ado, I would love to get the conference programming started. So I'm going to turn it over to Mr. Aaron Will from CBRE to introduce the panel on the investment market for active adult. Thank you.
All right, thanks everyone for joining. We've got a terrific set of panelists here. I know the active adult asset class is really a chameleon asset class, a hybrid between multifamily and seniors housing, which has garnered a tremendous amount of interest and come into its own in the last 5 to 7 years. So before diving into the subject matter, wanted to briefly introduce our panelists. We've got Aisha Menon from Welltower, Zach Crow from the Carlyle Group, and Jeff Patterson from Sparrow Partners, and I'll allow them to elaborate a little bit on their background and specifically how their firms got involved in the active adult segments of the market. Aisha?
Sure. Hi. I am an SVP at Welltower. I lead our development and wellness housing business lines. I've been with the firm for 2.5 years, and when I joined, it was to do a number of things, but one of them was help lead the growth of our asset base to include lower acuity assets that we felt complement really nicely our senior housing assets on the higher end of the acuity spectrum.
Hi, I'm Zach Crow with the Carlyle Group, and I've been with Carlyle for about 15 years, and for the past 10 years I've been focused on the active adult housing sector. It really began, almost 10 years ago, trying to create an investment thesis around the growing baby boomer demographic, and really created, started as a white paper for us, and now we've grown that to over 10,000 units through acquisitions and ground up development, really all over the country in big markets and more secondary as well, which we'll get into.
I'm Jeff Patterson, and one of the co-founders of Sparrow Partners that currently is exclusively focused in the active adult space primarily as a developer. And I got into the space. I was a new senior living broker when Zach was running around starting his platform, and I'm going to try not to talk too long, but was interested in the space. My colleagues who were from the traditional senior living space were telling me that active adult, or at the time we called it IL Light, was not senior living, and it seemed interesting to me. We did some research, wrote a business plan in 2013, and started in 2015. Here we are.
Terrific. And I'm Aaron Will, moderating the panel, and I co-head our senior housing platform broadly for CBRE, which is comprised of debt and structured finance, our mortgage banking book of business, our agency lending, and our debt fund business, as well as investment sales and capital raising. So, great. Well, just to kick it off here, an overview of this asset class. Again, it's kind of a chameleon, right, which has evolved tremendously over the last 5 years. There's many attributes of active adult which more closely resemble market rate apartments, right? The aesthetics, the design, in many instances, the rent structure closer to apartments than IL, which we'll get into further. But there's a lot of attributes of this asset class which more closely resemble senior housing, right? The resident profile, so far as age, in the early to mid 70s. It's got a tremendous amount of hospitality. You really need to derive a value proposition for your resident base, much like you do in senior living, to achieve rent premiums, significant rent premiums above market rates. So, active adult was birthed on the tax credit, side of the business many moons ago for developers to get projects off the ground that were a little bit less impact. And that has evolved tremendously into a lifestyle product in many instances. So we're going to talk a little bit about that. We're going to talk about the capital markets, how it's construed in a debt and equity context vis-a-vis multifamily or senior housing through the prism that folks see it through. And then we're going to end the session with some Q&A. So if you guys could hold the questions, I think you can submit them online, as I understand it, or through the application. Specifically, we'll spend the last 10, 15 minutes or so addressing questions for the audience. So with that, so I'd love to ask, maybe Zach, I'll kick it off with you, what exactly the product is and where does it fit within your various investment programs, defining active adult relative to age-restricted apartments, 55 plus, pure play. And does the latter, qualify or compete with the new purpose-built active adult you guys are building, Overture or otherwise, and kind of the evolution of the asset class as you see it?
Sure. So we have, I'd say, a wide umbrella where we just call really everything active adult, and there's multiple different kind of sub-specialties under that umbrella. At the far right-hand side, as Jeff mentioned, there's IO Light that has higher level of services, and then the other end of the spectrum, there's more workforce, age-restricted apartments with very little services. That literally is just apartments that are market rate with an age restriction of either 55 and older or 62 and older. And then there's models that are in between, and I really think the market is still evolving for exactly what that, what it is, and there'll probably be different names for all those different subcategories 10 years from now. But the way we look at it, it's really driven by demographics and psychographics of that particular market. In one market, residents may want housekeeping. In other markets, they may want meals. They may want continental breakfast. Or there may be markets where they're more price sensitive and they really just want housing and they want to be around their peers, and they don't view there being a value proposition with the service component. So we really do have a wide swath, from that spectrum, and I don't think there's any right answer for, this is the right active adult product. I think it really depends on the customer, the demographics, the psychographics, in that micro location. I think, again, 10 years from now, there'll be different price points, different service levels, just like there are with apartments and hotels. And I think we're still, in the second inning of that evolution of the asset class. But to answer your question on kind of where it all began, it from our perspective, what we've seen is the active adult space really did begin with a number of income restricted, affordable age-restricted apartments. And a number of folks were building those. They saw a tremendous amount of demand. Literally, these assets would be, leased with wait lists within, a few months of opening their doors. And then a few of these initial developers thought, well, why don't we try just making this market rate, but still being affordable, not being as focused on care and services that you have with traditional senior housing, and let's try that. So that's how a number of the original developers, 10 to 20 years ago in different regions of the country started building, true market rate age-restricted apartments for the first time. And I think it's been evolving in different regions, ever since then. But I would say the one characteristic that's probably worth mentioning up front that is generally consistent with all those different subspecialties is that the average age is in the low 70s. So it's generally 70 to 75. Sometimes it'll be up towards 80 if you have a higher level of service. And that to us was like one of the initial light bulbs that went off. Because our thesis, as I mentioned, was all about the baby boomers. And as everyone in this room knows, the average baby boomer now is 75. And the average age of these active adult properties for the residents is generally 72 to 75 years old. So we're really just starting to hit the front end of the baby boomers starting to age through kind of the meat of the market for, whatever you call them, age-restricted apartments or active adult.
That's great. Aisha, I'm going to turn it over to you with respect to, as I see it, there's kind of 3 or 4 segments of the market, right? There's and this is a misnomer because 75-year-olds typically aren't working, but starting with the workforce housing, if you will, segment of the market, right? The no-frills, 5 to 10% rent premium segment, moving on to the more middle income, more of Sparrow's kind of wheelhouse, 10, 20%, let's just say, rent premium, and then in the upper middle income to upper income. You guys your investment thesis by and large is investing in that, the kind of the swath, which is a little bit more affordable. Can you speak to?
Yeah, I'd be happy to. We sort of, and this whole space is a little bit amorphous, right? You get senior housing on one side, you get apartments, everyone knows what those 2 things are. And there isn't a clear definition for what we're talking about here today. We've tried to impose a bit of a framework on how to think about that. So you can imagine a sort of 2 by 2 with acuity being on one end, high acuity, low acuity, and then sort of financial need being the other sort of axis. And the way we've really wanted to position our portfolio, and this bleeds up into seniors housing, we really sought to position our portfolio at the place where there's some amount of need. So for our seniors business, we like to be at the higher income, high acuity end of the spectrum where acuity drives consumption of the asset and the offering. And for the seniors apartment, we've preferred to be in a place where there's some level of financial need or convenience that is helping to drive the decision to consume the product. There are a lot of versions out there, some that are higher end and seek to attract the renters by choice. And they're, Zach has developed some of these, and they offer a really wonderful way of living. We're trying to basically position our portfolio in a place where the total addressable market is large, and we found that some level of financial need and assets that are positioned and placed in places that offer a good fit for the demographics there or the folks that are migrating in give us the best durable long-term sort of opportunity to create a relevant product in the market. So we have sought to sort of own a collection of assets that are a little bit more middle income focused. And these aren't always people. I mean, I would say, quite far from a tax credit. That is true need. But we do find that a lot of the residents that move in are very sophisticated, have worked hard to earn their money, have worked hard to save it, and are really thoughtful around how they're financially planning for a longer and longer future lifespan, and making sure that their housing is, sort of fits the budget and gives them a great chance to live in a healthy way. Those are the things that we are looking for in terms of the way we've tried to seek out or build assets to fit into this part of our portfolio. Great.
Jeff, you guys, by and large, are focused on kind of the middle market to more upper middle market, 20, 25% rent premium. to market rate garden product, thoughtful suburban locations, moving up on the price point scale. Can you speak to that product, kind of some of the psychographics and what you guys are solving for and what you guys are doing specifically on the development side?
Yeah, and I'd like to take credit for a genius move getting in that middle market. We've gotten some feedback on how smart that was. The reality was we were teamed up at the time with a gentleman in Houston. I'm going to throw his name out there, Iggy Grillo, who's probably not here, but he helped us in the very beginning, had developed a couple in Houston, and that was just his approach. I don't think it was strategic for him either. But it's a segment of the population, I mean, using the senior living vernacular, this is all private pay kind of product, but we think our prospective resident or customer is someone that has made choices and has had to make choices over time. They didn't. I like to tell our team members, if you went skiing growing up every year, then you're probably not in our segment. So you probably had 2 big vacations. So they've had to make choices, but they have some discretion, and they've worked hard, they've sacrificed, and they have some net worth and they have some income. There's a whole variation, there's a whole spectrum even within our customer. But they have the ability. Most of 60% of I can probably say things that some of these folks can't say, so I'll try to, if this is helpful. About 60% of our residents sell a single family home to move in. They have very little debt. That's the majority of their net worth. They might have some invested capital. That's enough at $1,700, $1,800, $1,900 a month to live for 20 years. So that's our focus. Again, I won't take credit for it, but I have greater conviction now, understanding because I think they all work, and there's demand for this full spectrum of active adult product. But that's where we live, and I don't know if I answered the whole question. I mean, we look for we're looking for concentration right now. We're trying to be safe. Properties lease up very differently. If I think about how Phoenix is leasing up right now versus Houston, the concentration of residents that come from the local. From a 5-minute or 5-mile radius or 5 zip codes around the community versus Phoenix, which is a higher percentage, or Charlotte coming from outside of the area. A lot of that's intuitive, but it's been interesting to see not just how fast they lease up, which is probably what everyone's curious about, but which I would say is across the board. It's all over the place. But where they're coming from and what kind of decision they're making.
What about a quick question, adult children as influencers and kind of them partially rendering decisions or certainly influencing them as it relates to the move-ins? What percentage of your residents would you say are moving in to communities that are driven by where their adult children are living relative to where they're residing in y'all's communities?
If you're asking percentage, I probably the only one can answer that. Now, I don't. It's across the board, but like I said, Austin. Again, it's intuitive. Like there's variation. But places with high job growth, Charlotte, Raleigh, Austin. You're going to see more of that. This is probably no news to you folks who are coming from the senior living space. But the adult children, even if they're not relocating to be next to their adult children, or more importantly, maybe their grandchildren. Their adult children are typically involved at some level in the decision, which is very different from the multifamily space, at least.
Zach, you guys have probably the largest spectrum of 15 plus or minus operating partners in the space, the largest of which is Graystar, obviously, with the Overture product, which is a upper middle income kind of product, right? And or upper product and mid-rise and garden both. So maybe you could speak to that kind of segment of the market and how you guys think of it investing across all spectrums.
Sure. Yeah. So as I mentioned at the beginning, we really have done the whole swath, and I think there's probably an equal distribution of the more we partner with Jeff and groups like Clover that are more middle income, and then up we call it the more affluent model being Overture, and some have been high-rise, mid-rise, and then some of those overtures are, suburban, stick-built, relatively affordable as well, not too dissimilar from a Sparrow project. So we really do have kind of an interesting kind of data set across all those. But, I would say one interesting takeaway from seeing a number of these properties lease up. And it's kind of intuitive, after you see the data. The higher price point active adult properties are generally, if 60% is the average for folks moving from single family homes into an active adult community, the higher end communities, that number may be 80%. And so you're getting more people moving out of single family homes, probably more expensive single family homes that they're downsizing out of. So what we actually see in those properties, while they may be slower to lease up, the residents have higher incomes and a larger net worth balance sheet as well. So your rent to income ratio at those higher price point deals is actually the lowest of any of the deals that we own. And then at the more middle income segment of the market, you're getting more renters and and as Aisha mentioned, kind of renters by necessity, they will move in quicker because they can quickly, their lease comes up and they can quickly move from one apartment building to an active adult community. They don't have to sell their house and go through the whole downsizing aspect. So those properties will generally lease up quicker, but you'll have higher rent income ratios and I'd say a narrower headroom from an affordability perspective. And those rents will probably increase more in fixed income / inflationary measures where we've seen kind of higher rent growth and just a higher headroom as it relates to affordability. And I would also say probably more importantly is a stickier renter. Folks who move out of a single family home into an active adult community, from what we've seen, they are just less likely to then move into an all age apartment community. And I would say, across the board, one thing we hear all the time is that our residents really want to be with their peers. They really, when the number one marketing, thing that triggers them to come look at our properties is 55 and older. So they want to be in a quiet community with their peers that have programming that's catered towards their interest. And it really is a very, it's a happy place. It's a real sense of community. You go into the clubhouse, almost any time of day, and there's 20 folks hanging out doing something, that is fun to them. And, it's different at every community. But that's a really big deal for these folks. And so, on average, the average length of stay in these properties is 5 to 6 years. But it's actually a stickier resident and a longer average length of stay at some of those higher price point deals where folks, really have just downsized out of a single family home and do not want to move into a conventional multifamily deal where, some of the, at the other end of the spectrum, it's a little bit more, transitional, renters who may move back to that apartment community that they were in previously. So there's really pluses and minuses with both. And we've had some deals where actually the higher price point deals have leased up faster than the lower price point deals in that market because that's where the value proposition is for that market, and that's where the income qualified demand is for that market. So there really isn't any right answer for any market. It's very specific to what residents in that micro location, whether they're coming to be close to their grandkids or they live there already. It's kind of what they value, what they're looking for, and what motivates them to move. So it really is. I know you'll probably get tired of us saying it's all across the board, but we're really still learning. I mean, after almost 10 years of this, we're still learning every day what motivates these residents and to move into one property over another. So it's really fascinating information that we're kind of gleaning from all these properties.
Great. Moving on, maybe we could speak to kind of the general fundamentals of the sector, and more specifically, as I see it, during COVID, right, there was clear winners and losers in real estate. Industrial was a very clear winner. Multifamily, although there was a lot of forbearance initially, very clear winner as evidenced by the enormous cap rate compression, investor appetite for that segment of the market. Life sciences, medical office, same thing. And I think one asset class perhaps that's been overlooked is active adult. It was a very, very clear winner in that you didn't have the same issues with respect to inhibiting the ability of residents to move in. So the front door was still open, although leasing slower, right? And the performance was phenomenal, right? Renewals at 80%, collections by virtue of the fact that many residents, or most residents, I should say, are not working any longer, close to 100%, and really phenomenal rent growth now that you guys are achieving. Aisha, maybe you could speak to kind of your portfolio performance and what you guys have seen during the COVID era within
Yeah.
this segment of the market specifically.
Absolutely. It's by and large been very stable. The assets that were full already have remained that way, including we have a number of assets in Las Vegas, and we actually closed on those in January of 2020. So we were keenly watching to see what would happen. Assets remained full, and we were very pleased with their performance. What I would say is, you remark on how multifamily has been, has recovered with great strength. What we studied going into our decision to add this into our portfolio mix was in downturns, and we studied back in time in the Great Financial Crisis. We compared the performance of some of these assets with our senior housing assets, and we noticed that both of them were able to maintain stability even as multifamily assets saw RevPOR declines and some occupancy declines. So those two pools that we looked at, some of which we'd owned on the senior side, and then some that others had owned on the active adult side, we basically noticed that they remained very, very stable. And we'll talk about this a little bit later on. Aaron's going to ask some questions about asset allocation and portfolio composition, but we appreciated that, and we're expecting that to happen. Again, we obviously had no idea COVID was going to hit, but that's exactly how the portfolios behaved in that period. The properties that were in lease up, that was a much slower. It was a slower slog, and in different parts of the country, they behaved differently as well. So I don't think we have any great prognostications on why some parts of the country were slower than others, and our sample size wasn't really big enough for me to deliver any big wow moments there, but things have been really picking up recently. So I think overall we've been, the reality of the performance matched our expectations. We've been very happy with that.
Zach, Jeff, anything to add?
Same experience for us. High collections during COVID and low turnover. We were encouraged by that. We were mostly thankful that we had to implement some restrictions. We had to close clubhouses at times based on local mandates. Our residents did not like that. Some of our residents, but the point I was going to make, thankfully, we did not have any outbreaks, and we did not have to significantly restrict, their use of their apartment or sometimes even the clubhouse, the way I think some types of senior living communities had to. Leasing was slower for us. There's probably get different feedback on how impacted leasing was, and market to market, it correlated very closely to case counts and hospitalizations. But we came out of that, especially after leasing picked up again, very encouraged at how our communities performed.
Yeah, the only thing I would add that's different than what you just heard, we definitely had the same experience with our stabilized portfolio, remained very stable. Collections were 100%, across probably our 70 assets. It was over 99% in every single month from the onset of COVID until today. So that, from just a stability of cash flow perspective, it was very, very strong. Rent growth was positive as well during that time frame. So it was one of our best, if not the best, sector performance, at least definitely residential sector during COVID. But the other thing that was interesting, and this gets to another point that's worth discussing, is our staffing levels are generally 4 to 7, maybe 4 to 8 total FTEs per property. So when the pandemic hit and we didn't have communal meals, we didn't have a number of healthcare professionals coming in to the buildings every day, I think, and we actually still saw net positive absorption during COVID, even in our lease-up assets. It did slow down, but it was still positive. Occupancy kept increasing. I think that the customer realized that they could quarantine and be safe in apartments, similar to, living in a single-family home. And I was, honestly, I was a little bit surprised by that. But we shut down amenity areas. We didn't have really activities going on, but it was, it was a safe environment. We did a number of things to make it, as safe as we possibly could. We even went out and for free paid for, telemedicine, 24/7 a day for all of our residents across the entire country during the pandemic, to the extent they wanted, to just get advice or have questions or whatever it may be about healthcare. They could do that obviously safely, and just having, that low staffing level. I think that was one of the key ingredients to the success that you've just heard about. And then coming out of COVID, obviously everybody knows about the wage pressure and how, the 3 million people have ended their, have retired early, accelerated their retirement in the last however many months. And so thankfully in the active adult space, that has not been as big of a concern, as other sectors where you may have 20, 30, 40, staff members per property. But I think the key takeaway is that it allowed us to kind of operate the property safely. And I think our residents really, really appreciated that.
Great. So one of the big questions that, we've got a tremendous amount of deals in the active adult, very active, no pun intended, 20 plus or minus sales deals and a handful of financings going on right now. And a lot of the astute investors are posing questions about this asset class as the maturation occurs, right? Is what happens as residents age in place, right? In other words, active adult, this entire space, right, was birthed by virtue of the fact that the GFC happened. Age creep started to happen in independent living, right, where you had residents that previously were lifestyle renters in their 70s, moving in, traveling the world, so forth. And when the recession happened, people delayed the move, right? And so that independent living resident profile shifted from a 70-something-year-old to a low to mid-80s renter, right? Where it's not appreciably different from assisted living, it's just the individual care needs of that senior. And in most instances, seniors residents that have the foresight there, their adult children to say, it may be 2 months or 2 years, but I'm gonna need assisted care and wanna be in a congregate care setting. On the flip side of that, active adult, right, was really birthed to take care of the segment of the market who's a lifestyle renter in some form or fashion in their 70s, right? And so a lot of people are saying that's great, but what happens when these residents age in place and become 80 years old? Does this morph into IL, or does it continue to shift, or does it continue to active, to operate rather as active adult? And so again, there's a lot of investors that are posing this question. I think these panelists could probably shed light on it best, but maybe I'll start with Zach and get your mindset on that with respect to how you're seeing the age creep or not in your portfolio, and specifically what operational techniques you guys are utilizing to shape the resident composition and ensure that they're healthy, vibrant seniors relative to, IL, AL residents.
Sure. So yeah, this is a question we've heard time and again, and it makes total sense. If your resident moves in with an average age of 72 and they stay on average for, 5+ years, that very quickly your average age is going to go from 72 to 77, and the characteristics of that property are going to change within that 5-year time horizon. What we've actually seen, and we have a number of assets that are 20 years old now, is what has happened in our experience is that they move into the average age of 72. It's your older folks that end up moving out and move to a higher level of care. But as long as you're backfilling with younger residents in the 70 to 72 range throughout that time period, your average age will go from like 72 to 74, 75, and it plateaus. So, maybe the 80-year-olds on average move out and 72-year-olds continue to move in, and then you just hit this plateau of kind of 74, 75, and that's where it will stay. We have not seen in any of our, 2000, vintage 2000 and older assets, any properties creep up in age, over 75, honestly, which has been good. So I do think it is a long-term kind of the expectation on a long-term hold should be that, you're going to just have a steady state in that average age, with the one key characteristic that you're still able to attract younger residents, which is what we've been able to do in our portfolio.
Great. Yeah, we've so moving on maybe to some operational techniques, and we've spoken to a number of operators recently who even imposed restrictions with respect to home health in the units and so forth, really to maintain a healthy, vibrant resident base and not have the community shift into independent or assisted living. Jeff, how do you guys address that in your communities specifically, and how do you think about that?
Some of this is a cost consideration, but from the very beginning, in order to control our controllable operating costs, but also for this very purpose, we don't offer transportation, and with the exception of food and drink around activities, we don't offer food for this reason as well. We don't restrict the use of home health, but we also don't promote it. The reality is we know we have home health in all of our communities. It's pretty limited. To speak to age, the escalation of age or age creep, like our oldest building is 5 years old, so Aisha and Zach have a lot more experience with more mature buildings. But that's what we do operationally, again, for out of cost consideration, but also in order to encourage folks that need transportation and need regular food, and we see this, to move on to another housing option.
How about the programming, Jeff, specifically? I think it'd be enlightening for you to touch on what programming you guys offer and the value proposition, because you guys are kind of on one end of the spectrum, right, and do very minimal transportation and food service, and some of your peer set is offering that, right? So how do you guys deliver a robust resident experience and programming, right, which justifies that premium to market rate without offering those?
I mean, yeah, in our space, that's the difference. We call it lifestyle engagement, and while we are limited in this, we have this approach to keep rents as low as we can, so it's approachable or accessible to as many people as possible. But at $1,700, $1,800, $1,900 rents, it's more challenging to deliver the expected level of engagement and community from our residents, which is less than somebody paying $2,500 rents. And so we have a pretty robust activity calendar. We've been testing several software applications just to connect residents to each other, because sometimes the magic of a community, if you can really empower them to create their own activities and connect with each other, you can essentially get a lot of what they're looking for free. But it's the only difference between, other than being in a community with other people your age and not having kids or loud 20-something-year-old people around you, which is one reason people move in. They want to be engaged. They're lonely. They want to be active, and so it's a pretty significant portion of our controllable operating budget is just the cost of delivering this engagement.
Perfect. Shifting over to the capital markets, we've seen a tremendous shift in the capital markets in this segment of the market, maybe more so than any other real estate asset class as of late, and stuff has started to compress quite a bit, which is good and it's bad, good depending on which side. But we've seen a huge variety of investor profile types, senior housing REITs, traditional private equity, core plus funds, multifamily focused private equity fund, even multifamily syndicators, 1031 money, so forth, starting to chase these deals. So, and then traditional senior housing private equity and owner operators. So again, in our experience, the widest variety of investor types when running sales processes. So maybe I'll ask Aisha or Zach, who's emerged as kind of the dominant buyer profile in your experience within active adult most recently, and then we can move on to kind of valuations as you guys see them and closer to seniors or multi.
I would just say simply, it's definitely a wide swath of buyers. You see senior housing buyers, you see multifamily buyers. More recently, there have definitely been in the assets that we've been selling. There's and bidding on. There have been more multifamily buyers. Cap rates have definitely been trending closer to multifamily cap rates, and so I think multifamily buyers just by nature are more comfortable paying those low cap rates. And so that's been the majority of competitive bidders that we're seeing in the market today are really the multifamily core funds that have been doing research on this space and really like the characteristics that we've been talking about. Do you have anything to add?
Not really. I mean, I think a lot of the product we've seen has not been stable, and so that brings in a number of opportunistic players as well who think they can see the opportunity to fill the building up and then sell to one of those core buyers. So there's a fairly diverse pool of acquirers out there. It's been interesting to see how pricing has moved around, and I wonder sometimes what people are putting into their underwriting models to justify where they're landing on pricing. If you think about this asset class, generally the adage has always been a 25 to 30% rent premium, and you're having to spend something to earn that through the additional activities and programming, but there's flow through, and throw a multi-cap rate on that, you suddenly get to a pretty strong premium to replacement cost in terms of what some of these assets have been trading for. And so I think for us, we've been really focused on, you didn't ask about us, but I'm going to tell you what I think about how we've been approaching this, because we've oftentimes found ourselves vying to be the winner in some of these processes. We focus a lot on basis, and we focus a lot on the operator and how the operator is expected to drive value with the asset. And I think a lot of the bidders and the folks that are winning will be learning a lot about the importance of those two things.
And you guys, generally speaking, would say there's, so far as valuations, more kind of trending towards multifamily based on what you guys are seeing than seniors, or somewhere in between, depending on asset profile and geography?
Yeah, what we've seen, we've been tracking just every cap rate we can find over the last 5 years. We've actually seen that active adult cap rates have actually traded within inside, maybe by 20 basis points lower than multifamily cap rates. And I think that's due to the higher levels of growth and the stability during downturns that we've talked about, and that folks are willing to pay a premium for that cash flow stream. So yeah, it's definitely been, everything we've been involved with has definitely been right in line or slightly below multifamily cap rates.
Terrific. How about the lending community? Do you guys want to speak? I mean, from what we've seen as of late, it's again, it's a chameleon, right? And that there's deliberation now inside the agencies where it's processed, it's underwritten to multifamily standards, irrespective of whether it's processed by the senior housing groups or the multi groups. But there's a lot of debate on, because there's characteristics of both. But we found, healthcare lenders, some it's domiciled in their healthcare book, and some it's in the CRE book, right? And it varies lending institution, insurer to insurer, bank to bank, debt fund to debt fund. What have you guys seen in your book overall on the lending side?
We'll take that one.
I will share my more limited experience than Zach. I mean, we've financed, for the most part, with traditional bank construction financing, and it's regional and community banks. And we probably, I don't know, 8 to 10 different lenders, which we'd love to reduce. But a lot of times you're just finding, I do think there are lenders, you have to look, but there are lenders who get comfortable or already are comfortable with this space. But what we saw starting 2 or 3 years ago is just finding a lender that is having a good experience, whether the asset, some of the loans that they have outstanding should have been paid off or not, and just exposure to the space. So if we'd run into banks that had 2, 3, 5 active adult loans on their books, and we're going to wait to get to for some of those to pay off before they wanted to have any more exposure. I'm excited to see some of the sales velocity in the market, and might be tracking the commercial the lenders that are financing those projects because they're freeing up some capacity in the space. But so far, I mean, that's the profile for us as a lender. We haven't done any non-traditional financing or debt funds so far, but we saw some interesting term sheets that are higher leverage from loan funds, but that's been our experience.
Great. One last topic that may be interesting to talk about is kind of aggregation strategy is in your portfolios, and because it's a relatively new asset class, how you guys think about aggregating portfolios and portfolio premiums, right, to gain scale, because there's relatively few that have emerged with significant scale. Obviously, we have a couple institutional investors that have developed scale on this stage today, but how do you guys think about, maybe Aisha, Zach, you guys could touch on kind of portfolio and how you view that and as a portfolio premium or not in aggregating?
Sure. Yeah, no, there is not a lot of this product out there, that is for sure. And there's, I think, a tremendous need. There have been a few portfolios that have been presented. Our approach at Welltower is to underwrite everything fundamentally based on the opportunity that the asset presents to us. And that approach is the same for an individual versus a portfolio. So we don't give premiums to portfolios because of the immediate opportunity to achieve a mandate, for a volume of capital that we'd be putting out. Where portfolios sometimes do earn a premium, however, is if there are any sort of operational elements that having a scale in a portfolio would allow us to achieve some kind of a synergy in the way the properties are run. But for this, we have not seen that for these assets. Others probably take a different approach to that, but that's just the Welltower approach.
Zach, how about you? You've got a core plus vehicle buying. You're building and you're buying, so.
Yeah, we have started to see some folks that, if you add up the sum of the parts, appear to be paying a premium for scale. I do think with any, and not speaking to just active adult, I mean, any of these nation asset classes where it's hard to get product, there's just this scarcity factor where there's just too much capital chasing too few deals that you end up having a portfolio premium. And so we'll see if the market evolves to that. But I mean, there's definitely more and more capital that, is starting to understand the space, appreciating the resiliency factor, appreciating the growth, everything we've talked about today. And, and it's, as I think all three of us on this stage could tell you, it's really hard to scale in this space. It's really hard to develop. It's hard to lease these assets up. And there's not that much to buy that's stabilized, especially when they're trading at multifamily cap rates, and multifamily cap rates are really low. So I do think over time there will be a portfolio premium, as there's just the supply and demand imbalance of kind of capital and deal flow. So just my opinion.
There's smaller buildings too. I mean, you can throw down 300 to 400 units of multis and they'll lease up in 18 months. You can't do that for this product. So they're smaller.
That's a good segue into maybe some of the lessons learned, right? It's the last 6-8 years, as I see it, kind of chronicling it. It's been the wild, wild west in this asset class, right? And it's matured tremendously, but there's been a lot learned by everyone, including all the folks on this stage, right, that have are market makers, but by the same token are learning a new asset class themselves, at least certainly 6, 8, 10 years ago, right? So maybe you guys could each share some anecdotes and what you guys have learned based on your experiences. Or what is most important to you in lessons learned? Zach, I think.
Sure. I would reiterate something Aisha mentioned about the operator. I think having a sophisticated operator who understands this very nuanced space, which, as we've talked about, is a little bit multifamily, it's a little bit senior housing, it's a little bit hospitality. It's its own animal. And that sales pitch to convince someone who's been living in a single family home for the last 40 years, and that's where they've had, holidays with their families for decades and all their memories and their neighbors. There's an emotional attachment to staying in their home, and to have the right sales pitch to, reel them into to downsize, sell that home, go through the downsizing process, and move into an apartment, you really need the right sales approach, and you need the right operator. And so we've seen a number of folks, and we've had some of these instances ourselves, just treating it like a multifamily asset out of the gate, and just thinking that if you're priced right and you're priced in line with your competitive set, that you'll just lease up. And that has not been our experience. You really need to have experience and have a sophisticated sales and marketing platform specifically focused on active adult. And so I think that would be the number one lesson learned that I would just caution anyone who's thinking about getting into the space. I know Jeff can probably echo that, but
Are we sophisticated? I think, we probably take for granted what we know. It feels like we have a lot left to learn, but we really are increasingly considering pretty nuanced aspects of who our customer is. Where are they? Are we marketing to the prospective resident or the adult child? When we talk about, it's been mentioned several times, what's the premium of active adult over multifamily? I would say in general, ours is in this price point is 20 to 30%, but it's not, you don't just take the total unit mix and apply that across all floor plans. The makeup of the one bedroom resident, especially on the smaller end, is much more likely to have come from an apartment, and that premium is much lower. And if you go to our largest 2-bedroom unit, much more likely to have owned a home, sold a home, and that premium is higher. So there's a lot, you probably hear lots of average data points, and the reality we've learned is that it's a lot more nuanced than that. What should your pre-leasing target be? Is it a good return on your investment for the advertising dollars and the pain that putting a leasing trailer on a project that's barely framing? And we're vertically integrated by the way, so theoretically we would all get along and do this seamlessly. But we know we've learned a lot, and I think we are into some pretty detailed stuff. The more we look into it, the more we realize we have to learn in the space. But the sales, our first development underwriting model, I think, projected the lease up at 12 or 15 units a month, which that might not mean anything to you, but probably don't do that. Now it's market to market. We're still trying to figure out, is it 6, 8, 10 based on what we see in the underlying demographics? And some of the reason I think we see some pre-stabilized communities on the market is, I have an appreciation for this. What happens if you underwrite 12 to 15 units a month in lease up is you run out of interest carry and operating deficits. So, and then you either recapitalize it or you put it on the market and hope someone pays stabilized value for it. So I would say sales and marketing, and then the key 100% is people. There just aren't, just like there aren't very many active adult communities nationally, there's not very many people that show up and like, I know exactly how to do this. They come from the senior living world, and gosh, I was just talking to one of our sales managers in San Antonio, and I said, how do you think about the sales cycle? Like, does it feel slow to you? And he said, no. He's like, this is way faster than I've experienced. This is fast. I love these people. They make quick decisions. Talk to a multifamily salesperson or leasing agent, and we've had a lot of turnover in that space because they just don't have the patience. I mean, it's excruciating to some of them to wait. Now I got to meet with you 8 times and like talk to your adult children and see the grandchildren and all that. So people's the key. I think related to sales and then just delivering activities and customer service and being patient and loving seniors is important.
I'd add to the mix, we've just been pretty stunned at how important location is, micro-location, macro and micro. We've had the benefit of owning a number of assets that are built per a prototype and are run exactly the same way. And the differences between those oftentimes can't be explained by people or rate. It really, I think, comes down to location. And the differences, the deviation in the performance of those assets from some locations to others has been really tremendous. So we're excited by that as an opportunity on the development side, because if you can sort of crack the code on what will lead to great long-term performance, I think there's a big opportunity there. It becomes more challenging when you're acquiring buildings other people have built, because you obviously can't fix that. But a lens on how to understand that is something that we're also working on. So we've been using our data and analytical capabilities, which is part of our business we've been investing a lot in. And it has really been a great engine for us to sort of cast another lens on some of these assets and also grow with our partners in smarter ways.
Great. We promised we'd end. It looks like we've got some great questions here from the field. So we'll try to tackle these in the next 7 to 10 minutes if possible. Starting with, oops, went away. You've mentioned high amenity offerings for active adults. How much do the offerings impact cost of construction and development on a typical project?
So there are, I don't know how to isolate the cost of our amenity. I'll just tell you what our amenity package is. And one of my partners, Luke, who runs the development team, we've tried several different things. We've had a 8,000 square foot clubhouse and a 14,000 square foot clubhouse. We try to be, at our price point, we try to be as flexible with the amenity spaces in the clubhouse as possible. So you don't necessarily have, your flex room, which you're probably doing yoga in. You're probably also, what would be an appropriate craft today. You're having craft classes in there, and you put a sink in there, and you put tables in there that are flexible, so that you can limit the size of your clubhouse or your enclosed air-conditioned amenity space. And still provide flexible space for them. And we have pickleball courts still, and we have bocce ball courts, and dog parks are key that are actually functional. But we built a couple communities with a golf simulator, and then we stopped doing that. That was we'll probably find out after those those buildings deliver that was a key amenity. So it's I'm not answering your cost question, and I'm happy whoever asked that to follow up on that and maybe get you answers, but it's like you have to manage that. We probably see more than anything. We don't have salons. I'm not saying that's right or wrong, but we don't do that. But it's just a total space in delivering a product, at least in our price point, that's accessible. Because every little thing you add, do you have a movie room or not, all those things just adds to rent is the way I would look at it.
I'm glad you addressed the salon. That was actually another specific question, is whether it includes...
what was the question there? I said no salon. Right.
Yeah.
Well, that's our opinion. But.
Got it. One of the other questions, maybe I could just tackle that. Who will start tracking the metrics in this sector as its own real estate segment, and when? There's, again... not been a lot of data transparency in this space, right? And much like the senior housing sector was, prior to Nick and a few other organizations, but predominantly Nick, that got involved and said, we need data transparency in order to get institutional investment and track this asset class as a standalone. We're seeing the same thing, and one of the things that leading up to this, why it's the kickoff panel, and one of the topic du jour here at Nick is exactly that. There's a lot of dedication and resources at Nick being thrown at this asset class today, because it's an important segment within the seniors spectrum. So I can't say that Nick is the only organization that's set out to tackle some of these things, but I do know that it's an important initiative moving forward, and data transparency in the sector. On furnishing data on performance is one of the things that Nick is now focused on as one of its many initiatives. So let's see, are you seeing this asset class succeed in secondary and tertiary markets, or are there occupancy struggles outside of densely populated areas? I think maybe you could address this, because we've seen terrific performance in smaller markets.
I sort of struggle with those terms, secondary and tertiary markets. Like, Is that on population density? Is that on jobs? Is that like how fundamentally this asset serves a person who no longer feels their current housing is fit for them. And actually some of these more suburban locations, frankly with older housing stock, have been some of the best performers. And that makes a lot of logical sense. You know, that somebody's moving out of a home they raise their family in, where they have to go up to the bedroom and into the basement for the laundry, and the stairs just become, you know, sort of not a part of the future they envision for themselves. So we definitely believe there is an opportunity to deliver this kind of housing across the country in a lot of different types of markets, including ones that multifamily developers don't typically think about building in. And again, I come back to supply and basis. I mean, that nothing's to stop someone from plunking something else down in a low density area where land is plentiful. So you have to be thoughtful around, you know, what the basis is you're going to own at. In some of those markets, you can't keep producing supply the way, you know, Texas seems to be able to absorb supply in. So you just have to sort of be thoughtful about the way you're investing in those types of markets. But I think there is an opportunity for this asset class to serve a great need in many parts of the country.
Great. This is a fascinating question. How do you see technology being a factor to impact ROI with the specific help of social engagement and the people connection? Any insight in using technology to differentiate and grow census?
I would just mention, I mentioned before, you know, our implementation of telehealth, telemedicine to our properties. We've definitely used, you know, Uber and had a concierge who's kind of responsible for that. There's been specific senior-oriented, you know, Uber, or I think it was actually Lyft, has a service specifically for the boomer cohort. So I do think that, and there's obviously meals and grocery delivery. I mean, I definitely think there's a large opportunity for technology to play in this space as well, where you just don't have to, you know, you can leverage, like we said at the beginning, you know, 5 to 7 FTEs at your property and leverage other, you know, retailers that are around your organizations to provide services. I think the key, though, is that you're able to provide services that the residents want, and it's not, you know, a cruise ship model, so it gives people more choice. And we've dabbled in that, and it's been relatively successful.
Great. This is the last question. I apologize. There's more questions here than we maybe anticipated, but this is kind of a fun one. Any sense that the people who are moving in tend to be young for their age, old for their age, or act their age?
I would say young for their age. I mean, we were hoping to have some time to tell fun stories, which I love doing, but I'll just say, like, these people show up, and one of the encouraging things is how meaningful this has been. I mean, I for sure was attracted to this based on the underlying demographics and the growth of the boomer, but this is a product, especially in the middle market, that provides provides community for folks that there's not currently a product for that they can afford. And a lot of our residents have to unlock the wealth in their single-family home in order to be able to afford that and have a viable financial plan for the duration. And so a lot of people show up. Our biggest persona is a single woman that's been widowed or divorced, and they say they're they're tired of taking care of their house. You know, like it makes sense, but they show up, and what they really were, they're also lonely, you know, and their kids aren't showing up as much. And so I would say it is what we are doing, and my conviction around it now, and the reason I hope to do this, you know, for as long as we can, and as long as these two folks will capitalize their deals, is very meaningful. Not just a housing option, is providing meaning and engagement, and we think, you know, years on our residents' lives. So, sorry,
Yeah.
went off on a.
No, and I would just reiterate there, because I do think it's worth mentioning that the residents are definitely young for their age. We have some properties where there's 100-year-olds living in these active adult properties, and they're just as active and healthy as a 60-year-old who lives there, and they, so it's amazing to see just like that vitality at that age of their life. And we've had so many residents that have come in that have never done water aerobics before, done yoga or Tai Chi, and all of a sudden they start doing it, and they're healthier for moving into these properties. They're mentally more stimulated, physically getting more activity, and they create this social network with the residents that is really unique to find that in residential settings. And I think that's why the average age of a lot of these properties is, 5, 6, 7 years, sometimes longer, because it's really this tight-knit community where they become very, very close. I kind of think about it, I'm, in my 30s and have 3 young kids, and we've become super tight with all the, other families living in our neighborhood, and they're your neighbors, and it's it's that sense of kind of a neighborhood that's in these multifamily buildings, where as Jeff said, as opposed to the alternative where a senior is in their house, a single person, living in a single family home, having to keep up with the house, kids aren't coming around, they are lonely. To move into an active adult community where there's 10 activities a day, and you can just go into the clubhouse at any point in the day, and there's just stuff going on. And it's really, I think I just wanted to stress that piece of it, because it really, I think, helps with longevity of life, and really, it's just been so rewarding to see all these residents just love living at these properties. And a lot of these markets, there's a void in the marketplace for that product. So that's been the fun part for us, is to see that kind of meeting that need out there in the market.
That's great. Okay, well, thank you guys for coming to the session. Hopefully you guys found it informative, and we'll any follow-up questions, feel free to ping us. But we appreciate you guys coming, and go Astros.
Thanks.